Looking to build wealth through dividends but unsure whether SCHD or VYM is the better choice? The question often lingers in the minds of both new and seasoned investors. These two popular dividend ETFs have been making waves in the market, each offering unique benefits. But which one is truly the right pick to grow your wealth? In this video, we'll dive deep into SCHD and VYM, comparing their performance, dividend yields, expense ratios, and more. Whether you're focused on building passive income or maximizing long-term returns, this analysis will help make you an informed decider. Stay tuned to discover which ETF might help you achieve your financial freedom faster. Dividend ETFs are an excellent way to build wealth while earning a passive income. These funds pool together a variety of dividend-paying stocks, offering investors exposure to numerous companies with a single investment. This diversification reduces risk while ensuring steady cash flow through consistent dividend payouts. They're particularly favored by long-term investors who want both income and growth potential without the hassle of picking individual stocks. What makes dividend ETFs so popular? First, they offer consistent payout, which are perfect for retirees or anyone looking to supplement their income. Second, their potential for growth means you're not just collecting dividends but also benefiting from capital appreciation over time. Whether markets are bullish or bearish, dividend ETFs tend to remain a stable option. Two standout names in the space are SCHD and VYM. Both are well regarded for their performance and low cost, but they cater to slightly different investment goals. SCHD focuses on high-quality companies with sustainable dividend growth, while VYM emphasizes high current yields. Let's explore these two ETFs to see which aligns better with your financial objectives. Let's start with SCHD, one of the most popular dividend-focused ETFs in the market. SCHD tracks the Dow Jones U.S. Dividend 100 Index, which includes high-quality companies known for consistently paying sustainable dividends. With an expense ratio of just 0.06%, it's one of the most cost-effective options available, ensuring more of your returns stay in your pockets. Its dividend yields hovered around 3.6%, making it an attractive choice for those seeking both income and growth. Some notable holdings include PepsiCo, Merck, and Coca-Cola, all household names with a long history of strong performance. SCHD's focus on companies with excellent fundamentals makes it ideal for long-term investors looking to compound their returns. On the other hand, VYM tracks the FTSE High Dividend Yield Index, which is composed of companies offering above-average dividend yields. Like SCHD, it also has a low expense ratio of 0.06%, which ensures cost efficiency. However, its dividend yield sits slightly lower at around 3.1%, reflecting its focus on current income rather than dividend growth. VYM tends to favor value sectors such as energy, utilities, and financials, making it more stable during market downturns. Its top holdings include Johnson & Johnson, ExxonMobil, and JP Morgan Chase, companies renowned for their reliable payouts and strong market position. Both ETFs have their strengths, but their differences cater to different types of investors. SCHD is one for those looking to balance income with capital appreciation, while VYM appeals to those who prioritize higher current income. Which one suits you better? Let's break it down further. When it comes to choosing between SCHD and VYM, understanding their historical performance and dividend growth is crucial to determining which ETF better suits your long-term financial goals. Over the past decade, SCHD has consistently delivered strong returns, often outperforming many of the dividend-focused ETFs. One key reason for this is its growth-oriented strategy, where it selects companies with a strong potential for capital appreciation alongside steady dividend payouts. SCHD's focus on high-quality blue-chip stocks like Coca-Cola, PepsiCo, and Merck has paid off, as those companies have experienced significant growth on both dividends and stock prices over the years. As a result, SCHD has provided investors not just income, but solid total returns, benefiting from both dividends and capital gains. In contrast, VYM has provided stable returns, but its focus on higher-yielding stocks means it tends to be more conservative in its growth outlook. VYM's focuses on sectors like energy, utilities, and financials, and often leads to more stability in periods of market turbulence, as these sectors generally are less volatile. However, this emphasis on high current yields often means that VYM doesn't experience the same level of growth during bull markets as SCHD does. The dividend yield on VYM may be attractive for income-focused investors, but it lacks the same growth potential in terms of capital appreciation that SCHD offers. This makes VYM a better choice for those looking for steady income, but potentially less so for those seeking growth in their portfolios. Dividend growth. SCHD emphasizes dividend growth, which can be an excellent strategy for long-term wealth building. The ETF selects companies with a strong track record of increasing their dividends year after year, which is crucial for compounding. Over time, these growing dividends can lead to a significant increase in income. For example, if you had invested in SCHD 5 years ago, you would have not only seen the appreciation in the underlying stock prices, but also a steady increase in the dividend payouts, which compounds your returns over time. This growth-focused approach makes SCHD an ideal choice for those who are building a portfolio with the goal of maximizing compounding effects over several decades. In comparison, VYM offers higher current yields but places less emphasis on growing payouts annually. While VYM's dividend yield of around 3.1% might be attractive to those seeking immediate income, it typically doesn't offer the same level of dividend growth that SCHD provides. The companies within VYM's portfolio, such as ExxonMobil and JP Morgan Chase, tend to be stable but don't have the same aggressive growth trajectory for dividends. For investors who prioritize steady income over long-term compounding, VYM may be a suitable option. However, for those seeking to build growing income streams, SCHD's focus on dividend growth may be the more appropriate choice. When it comes to volatility, SCHD and VYM may behave somewhat differently due to their respective sector allocations. SCHD tends to be slightly more volatile because of its exposure to sectors like tech and consumer discretionary. Companies in these sectors, while strong performers, can sometimes experience more price fluctuations, especially during economic cycles or market shifts. For instance, during market downturn or corrections, tech stocks in SCHD's portfolio may face larger swings, but often they rebound quickly in bull markets, providing a greater long-term growth potential. On the other hand, VYM leans closely towards stability with its heavy allocation on defensive sectors such as utilities, consumer staples, and energy. These sectors are known for their resilience during market downturns, making them a more stable choice in terms of volatility. While this means that VYM might not experience as much upside during a market rally, it does offer less risk for investors who are more concerned about short-term fluctuations and prefer a steadier income stream. If stability and low volatility are important for you, VYM may be the safer bet. But if you're looking to capture more growth during favorable market conditions, SCHD's more aggressive exposure to growth sectors might be a better fit. Choosing between SCHD and VYM depends on your investment goals, risk tolerance, and income needs. Choose SCHD if you want a strong dividend growth over time. SCHD's emphasis on dividend growth ensures that your income will increase year after year, making it a good choice for long-term wealth building. You're comfortable with moderate volatility in exchange for higher long-term returns. If you don't want some price swings and are focused on capturing growth, SCHD's exposure to sectors like tech and consumer staples makes it ideal. You're looking for exposure to growth-oriented sectors like tech and consumer staples, which can provide not just dividends but also capital appreciation in the long run. Choose VYM if you prefer higher current income over growth. With its focus on higher-yielding defensive sectors like energy, healthcare, and financials, VYM is a great choice for those seeking immediate stable income. You want a more stable defensive portfolio. VYM's heavy allocation to sectors that tend to perform well during market downturns makes it a solid option for conservative investors looking for low volatility. You're focused on established industries like energy, healthcare, and utilities, where companies typically pay reliable dividends and are less prone to market swings. If you're looking to diversify your portfolio and want both growth and stable income, consider holding both SCHD and VYM. This approach allows you to balance income generation from VYM and the growth potential of SCHD, creating a more resilient portfolio that can weather both market downturns and benefit from long-term appreciation. While both SCHD and VYM are strong ETFs, it's important to acknowledge the risks involved in investing in dividend ETFs. Dividend ETFs are not immune to market risk. During bear markets, both SCHD and VYM can experience declines in value. SCHD's focus on growth stocks, particularly in the tech sector, can lead to underperformance during market pullback. Conversely, while VYM's focus on higher-yielding defensive sectors may offer stability, the sector in its portfolio, such as the energy and financials, can still face challenges during economic slowdowns or if interest rates rise. Both ETFs are well diversified, but each leans heavily toward specific sectors. For example, SCHD has a higher concentration in consumer staples and tech, while VYM is more focused on energy, healthcare, and financials. If these sectors underperform or face challenges, it could negatively impact the performance of the ETFs. It's important to monitor sector trends to ensure they align with your investment goals and risk tolerance. Now that we've compared SCHD and VYM in detail, it's time to decide which dividend ETF aligns with your financial goals. SCHD, with its focus on growth-oriented dividend stocks, is a great choice for those looking to balance income with long-term appreciation. Meanwhile, VYM, with its focus on high-yielding defensive sectors, is ideal for investors seeking stable income right now. Both ETFs offer unique advantages, so the choice depends on whether you prioritize growth or immediate income. We encourage you to start your investment journey today and let these dividend ETFs help you build passive income and long-term wealth. It's never too early to start investing for your future, and whether you're just starting or looking to emphasize and optimize your portfolio, these ETFs could be the key to achieving your financial goals.